In this lesson, we're going to record our first finance lease from the lessee's perspective. Here's the mindset I want you to bring. Let's assume that we've decided in classification that this lease is a purchase in disguise. So we're going to account for it exactly the way that the sentence suggests, as a purchase of an asset financed with debt. If you are comfortable with bonds and notes, you already know that most of what's coming, because a lease liability is just another exercise in amortizing debt. Think about what happens the day you sign a finance lease. A machine shows up at your factory, you control it, you'll use it for essentially its whole life, and you've signed a binding promise to make payments for years. Economically, you bought an asset. You just haven't finished paying for it yet. The accounting should say exactly that, an asset on the books and a debt on the books. So here's the Inception entry. Debit, right of use asset. Credit, lease payable. Both for the same number, the present value of the lease payments. Why present value? Same reason as bonds. The lease payments happen over many years, and dollars in the future are worth less than dollars today. The liability we've really taken on isn't the sum of the payments, it's what those payments are worth today, discounted at the interest rate that we signed in the deal. And the asset we've acquired is worth exactly what we agreed to pay for it, that same present value. To compute that present value, you need three ingredients. First, the payments, the fixed amount we've agreed to pay each period. Second, the rate. We use the rate that the lessor is charging in the lease, called the implicit rate, if we know it. If we can't determine it, we fall back on our own incremental borrowing rate, which is what we pay to borrow similar money for a similar term from the bank. Third, and this is the one that trips people up, the timing. Lease payments are almost always due at the beginning of each period, not the end. You pay rent on the first of the month, not the 31st. In time value terms, that makes the lease payments an annuity due rather than an ordinary annuity, and it means that the very first payment happens at inception, before any interest has had time to accrue at all. Just like with bonds, we keep track of the math with an amortization table, and I want to walk you through one. One illustrative lease here, payments of $25,000 a year for 4 years. Payments are at the beginning of each year, and there's a 10% implicit rate. The present value works out to $87,171. That's our starting liability, essentially our purchase price. Now watch the first row carefully. The first payment happens at inception, time 0. No time has passed. So there is no interest in that payment. The entire $25,000 reduces the overall liability. That's the signature of an annuity due, and it's the single most common mistake students make. They'll charge interest in that first payment. Don't do that. After that, every row works just like a bond. Interest equals the rate times the outstanding balance, and the rest of the payment reduces the balance, and the balance walks its way down to exactly 0 with the final payment. The table self-corrects to land on 0, and that's how you know you built it right. Essentially what it's doing overall is taking each of those annual payments and just telling us how much of that payment is principal and how much of it is interest. It's just a systematic way of allocating that payment to those two different concepts. Now, for the income statement, a finance lease produces two separate expenses every period. First, interest expense, the rate times the outstanding balance. Second, amortization expense on the right of use asset. We generally amortize it straight line over the lease term, cost divided by the number of years, the same way you'd depreciate any other asset. Notice what that combination does to the pattern of total expense. The amortization piece is flat, but the interest piece is biggest in the earliest years when the balance is the highest, and it shrinks over time. So total expense is front-loaded, higher in the early years, lower in the later years. File that away because it's exactly the pattern that operating leases are designed not to have, and it's a favorite conceptual question. Let's do one from scratch. Here we have a 3-year lease, $10,000 per year. Payments are at the beginning of each year, 10% rate. We'll compute the present value, build the full amortization schedule, and then we're going to record every entry for year 1. Inception, the first payment, the year-end interest accrual, and the year-end amortization of the right of use asset. The first thing we need to do is calculate the present value of the minimum lease payments, which in this case are $10,000. So I'll build our formula here with our 10% rate, and Excel's going to help us figure out the formula here. We also need our 3-year term and our payment of $10,000. We do not have a future value here, so I'm going to leave that blank, and I'm going to add a 1 for a beginning of the period. That works out to be $27,355. So that is the lessee's lease liability. It's what they would pay today if they were to buy this asset in cash outright. So that's the balance of their lease liability, and that's what we need to look at in our amortization table, or start with in our amortization table. So I've got a row here for inception, and I also have a row here for the first payment. So the first payment is $10,000. And no time has gone by. It's still January 1st, the first year, so there is no interest. All of this payment is going to be allocated to principal, which means it will go to reduce my liability. And we're working to reduce our liability to zero over the course of these 3 years. The next year, I'm going to make a payment of $10,000, and I do need to calculate interest because a year has gone by and I'm not paying off the whole liability. So I'll take the balance of my liability and multiply it by the interest rate of 10%. So that's the amount that I'm going to allocate to interest from that second payment, and the rest of it will all go towards paying down the principal of the debt. So I'll take 17,355, which is the balance, and subtract the amount I'm allocating to principal. Then finally, I will have my third payment of $10,000, and I will take that balance and allocate some of it to interest, 10%, and the remainder will go to principal and reduce my balance of my liability down to zero. Then we can go ahead and build our journal entries. As you can see here, I've already built the journal entry where I'm going to debit an asset and credit a liability. And the amount is that calculation that we did at the beginning, the present value of the future minimum lease payments, and that is $27,355. The lease liability that I want to debit and credit to cash is my first payment. Remember, I made a payment of $10,000 on this same day, the first day of the lease. Next, we need our year-end journal entries to record interest expense and interest payable. So I need to debit interest expense. Always expenses are debits. And my amortization table tells me exactly how much. So the interest expense on December 31st is the amount that I'm going to owe tomorrow on January 1st of $1,736. I don't have to pay it until tomorrow, so it becomes interest payable. And that is my second journal entry, my year-end journal entry. Then I have also my amortization expense, which I need to record as taking the value of the asset, the right of use asset, which is the amount that I recorded here, 27,355, and divide that by the number of years in the lease term. Not the useful life. If they had given me a useful life, I don't care about that. I need to use the lease term. And that is the amortization expense, year-end entries. Second payment, I will debit the interest payable that I had recorded on December 31st. And I will also debit the lease liability for the amount that's going to go towards principal of $82.64 and credit cash for that second payment of $10,000. And there you have your journal entries for the lessee for a finance lease. To wrap up, a finance lease is recorded like a purchase, exactly like you would record it if you went to the bank, you borrowed the money, and then you used it to buy an asset. Only we have to calculate the purchase price here based on the payments we've agreed to make. Payments are at the beginning of each period, making it an annuity due. Don't forget that the first payment carries no interest because no time has gone by yet and reduces the liability dollar for dollar. Each period after that, we record interest expense on the outstanding balance, straight from the amortization table, plus straight line amortization of the right of use asset, essentially depreciation. Next lesson, we're going to cross the table and keep the lessor's books.